All right. Good morning, everyone, and welcome to Subterra Renewables' inaugural webinar series. My name is Karim Mirza, and on behalf of Subterra Renewables, I will be your host and moderator for this exciting webinar in which we will discuss recently legislated tax incentives for renewable energy investments in Canada. Subterra Renewables is the largest vertically integrated end-to-end geothermal heating and cooling utility in North America. Just a few words about why we're here. There's a little doubt that we are in the midst of a climate crisis. Practically no doubt at all, actually. In solving this problem, we've seen many major cities in North America, such as Toronto and New York, adopt strict building standards that require new developments to be emissions-free. We also know that the new generation of renters and buyers are extremely climate conscious and are willing to pay a premium for living in emissions-free buildings. What we now have in Canada is leadership from the federal government on this issue. The latest budget includes impressive tax credits that make the adoption of renewables quite literally a no-brainer. Now, to that end, I'm pleased to introduce our first speaker. Andrew Karakas is a senior partner at Deloitte and is an expert at tax incentives. His firm, Deloitte, needs no introduction. If you have any questions during his presentation, please make note of them and submit them on the Teams Q&A during question period. With that, I'm going to hand it over to you, Andrew. Please take the floor.
Thank you, Karim. Good morning, everybody. First off, thank you, Karim, Matt, Kyle, for the opportunity. Very grateful to be presenting today and also to be working with Subterra. It's a great company with a great mission, and we're pleased to be partnering with you here. Secondly, to everybody who's made the time, you could have done anything with this hour and you chose to be here, so thank you for investing that time with us. We'll get right into it. The first thing we're going to talk about is how we came to be here. So as I present you with an eye chart that we have no hope of covering in detail, take a few seconds to read it as I'm going. I'm just going to make a couple of key points. The Cleantech ITC, which we'll unpack in a little while, is part of a greater package produced by Canada to support clean technology and a transition to a clean economy, as well as a coast-to-coast, reliable and scaled clean electricity grid. Those two things are significant in the sense that they're going to help us achieve our 2050 and 2030 climate goals, and also from a geopolitical and economic standpoint, position Canada to be a successful place for local innovation, foreign direct investment, and long-term economic growth. So make no mistake, these programs are part of a package that's meant to go from raw materials and research and development all the way through product manufacturing, sales, and ultimately user adoption, and create a landscape where our economy is going to transform. We've been talking about this for decades. Canada's been natural resources focused for my entire life, and I'm 43. And it's not going to be at the end of my life. So this is a bit of a linchpin moment. The other thing that's interesting is that the Inflation Reduction Act came into focus between the fall economic statement and the budget. And so I believe a number of the initiatives that we saw in the budget that are broadly listed on the screen here were either invented or accelerated just in that 3-month window. So what does that mean for all of you? What it means is that we're long on ideas right now, and government still needs to do some execution to bring these things to life. None of the ITCs have been legislated. All of them have been announced. We don't expect any reversing of course or any changes to the things that we know, but there's still quite a lot that we don't know, which will be finalized when the legislation is signed into law. We believe that'll happen this calendar year. But government goes at government speed. So I think another thing that's particularly relevant to this audience is that geothermal got a call out. So in the initial clean tech ITC description going back to budget 2022, it was talk of zero carbon heating, zero carbon cooling. In fall economic statement, it said air and ground source heat pumps. So we're sort of zeroing in a little bit. And then in budget 2023, they kind of said, you know what, just in case there's any mistaking this, we are going to fund geothermal. So even though this legislation is not signed into law, it would be stunning if they didn't follow through on that. So geothermal very clearly a priority item for government and something that you can expect a tax credit on going forward. So let's run through the 5 ITCs themselves just to provide a bit of context. So government has a whole pantheon of ways that they provide stimulus. You've all heard of government grant programs. ITCs are investment tax credits. That's a specific vehicle that works a certain way. In this clean technology bucket, 5 ITCs were referenced in the budget. I'm going to go through them in order. We're not going to unpack any of them later today other than the clean tech ITC, which is going to be of particular interest to you, but I think it's helpful to have a broader picture. Before I do that, I'll explain ITCs generally provide you a tax rebate for rebate refund credit for expenses that fall into a pre-existing category. These 5 ITCs are refundable at a particular rate for assets that are purchased and installed within certain asset classes in the tax code. So all of this is pre-existing infrastructure. It's not like a grant program where they start with a blank page, they make you make your case, plead with them for why it's relevant, and then make sort of a discretionary decision. When this is signed into law, if you comply with what's in the tax code, you will get the money. There's no gray area. And geothermal has been called out as part of class 43.1, which is getting the 30% refundable ITC. So really, even though we don't have legislation, quite clear how this is going to work. So I'll run through them now. The carbon capture ITC, very specifically targeted at heavy industry. There are a lot of different ways you can capture carbon and sequester it. This ITC only contemplates 2. Geological sequestration, which is basically pumping carbon into the ground in a place where there's the right type of rock, or sequestration in cement. So this puts off the table a majority of carbon capture technologies that are not deemed yet mature enough. And the reason it's being done this way is because oil and gas needs to get moving on decarbonizing their operations. So there are more ways you can use this tax credit, but it's clearly targeted at that group. I could talk at length about that, but today's not the day. The hydrogen ITC, I'm going to come back to clean technology. The hydrogen ITC is a tax credit on equipment used for hydrogen production, meaning if you are going to buy equipment that you're later going to use to make hydrogen, depending on the cleanliness of the hydrogen you're going to make, you're going to get a tax credit on the cost of that equipment. So once again, it's falling into an asset class. It's not your project cost. It's not your facility cost. It's equipment within this asset class used for this purpose, producing hydrogen of this grade. The clean technology manufacturing ITC works the same as the hydrogen one in the sense that it's for equipment used to make a thing, in this case, clean technology. That doesn't mean the Webster's definition of clean technology. It means the CRA's definition of clean technology. So just as we've defined geothermal as part of clean tech, if you're making something else that's part of clean tech, you're in. If you're making something that you think is clean tech that isn't in the tax code, you're not in. And so the mechanics of adding things to these asset classes over time is going to vastly increase the scope of eligibility. For today, this looks like manufacturing of renewable energy, manufacturing of zero emissions heating and cooling, and manufacturing of thermal and electric storage. Clean electricity ITC is one of the ones that was, we believe, dreamed up as a response to the Inflation Reduction Act and also partly from industry petitioning the government. Basically, it's for grid scale renewable projects undertaken by any entity, but is refundable to entities that are not taxable. So this is where utilities will get some money. This is where hospitals and universities will get some money. It's very specifically answering the question, what about the public sector? And it's refundable only at 15%. So that brings us to the ITC of the hour. The clean technology ITC is fully refundable if you are not tax exempt. It's a bit of inside baseball, but saying you're taxable doesn't necessarily cut it. You have to be not taxable. So really, all this is really saying is that if you are a university, a hospital, a not-for-profit, there needs to be some structuring done, and the asset has to be owned by an entity that is not tax exempt. It can be done. It's a conversation for another day. Please reach out if you'd like to discuss. The tax credit is refundable at a rate of 20 to 30%. It's actually 20 or 30%, depending on whether you adhere to labor standards that are set out in the legislation. I'll come back on this point and elucidate on it a little bit later. It covers the use of assets defined as clean tech. So I mentioned that before. It's assets in class 43.1, 43.2, and another class, and broadly includes renewable energy, zero emission heating and cooling, battery storage, electricity storage, and thermal storage, and non-road zero emissions vehicles. So if you happen to be a mine operator and you want to electrify all your big dump trucks and things like that, that would count, but it specifically doesn't count for street legal vehicles. That's a whole separate kettle of fish. So the eligibility date is from the date of the budget. So, and that doesn't mean expenses, that means landed costs. So the solution is in and working and in service no earlier than March 28th, 2023, which means if you have projects underway, they're going to be eligible. If you delivered them on March 27th at 11:59 p.m., they're not. Once again, this is a black and white thing because it's tax code, not a grant program. So that is something that unless the legislation changes, government will stick to. And then they contemplate this until 2035. So that's significant because you as a business owner, as a building owner, need to be confidently making these investments. So I actually think these tax credit programs will be enhanced and extended. But for now, we know until 2035, this is going to be a safe bet once the legislation is completed. Actually, let me back it up one more, Kyle. Just back to that one. So another thing that's relevant is that it stacks with grant programs. So if you do have a government grant, it's going to change how you apply for the tax credit, but you're allowed to do both. It doesn't stack with the other ITCs in the clean tech package. So there is a best way to handle this. It's one of the things that we advise our clients on. But generally speaking, what you want to do is look at all the programs that you're going to qualify for before you start spending the money and make sure you know what the best way is to capture those funds. Sorry about that, Kyle. You can go ahead to the next one. So delving into some of the fine print, the labor condition it basically says, you have to pay the prevailing wage to people who are doing physical work. So this is trades and installers and things like that. The prevailing wage is defined as the most recent collectively bargained union contract in the jurisdiction in question, but it has a carve out specifically for heating and cooling. So for geothermal, for heat pumps and things of that nature, this labor condition doesn't apply. You just get the 30%. If you're doing that and you're buying solar panels, the physical labor on the renewable energy piece does apply. And what that means is the owner of the asset is that you are accountable to know how much the laborers were paid. And if you claim the 30% and on audit it's deemed that they weren't paid the right wage, the government is saying that they will assess you at 20%. They'll ask for the money back. They will charge you basically like a levy. They don't call it a fine, but really it's like a non-compliance fee. And they'll charge you interest on however long it took to square things. But then they also go on to say that they're going to direct that money to the people who actually did the work and top up their wages. The mechanics of this stretch credibility. Tax programs don't usually have the ability to sort of true up and pay different people and things like that. So I'm very interested to see where this lands. I do not think they're going to walk back the fact that the owner of the asset is accountable for knowing which rate they should claim. So this should change your behavior when you're talking to your solar installer, but it actually is irrelevant to geothermal because there is that carve out and it's meant to be refundable at 30%. Nothing changes. Not something you need to worry about there. Second point, I mentioned this. I'm going to say it probably right until it's legislated to anyone who will listen. This is not finished. The legislation hasn't even been started. The ink is not wet, let alone dry. That having been said, no anticipation that anything's going to be walked back, just that a lot of your questions about specifics can't be answered definitively. Tax code is satisfying in that in the end, there usually are definitive answers. We just don't have them yet. The other thing I think that's very relevant is that the ITC package and the grant programs and things like that are providing you an incentive. The stick is going to evolve quite a lot. So carbon taxes are something that we've been dealing with and thinking about for a little while. Kareem mentioned building code changes off the top. That is a trend that we expect to pick up steam and become more demanding over time. So when you're looking at the type of decision you're going to make, and you're basically asking yourself, do I want geothermal or do I want a fossil fuel burning boiler? Aside from the imperative that we all have to try and protect the planet we live on, the business case isn't just driven by the economics of the project, and which now includes this tax credit. There's a future outcome that is going to get worse over time. And I don't think anybody should be on the record saying this is what's going to happen with building code and carbon tax, because we don't know for sure, but we know it's not going to get easier, it's going to get harder. So with the life cycle of these assets being usually decades, what I would generally advise is to get in early and benefit for a long time, rather than wait until you say to yourself, I should have done this 5 years ago. So moving right along, where do we see this stuff being used? We think portfolio building owners are going to look at this in two ways. One, from a like ongoing capital cost standpoint. Like if you own enough buildings, you have to replace some fossil fuel burning thing every year. And hopefully now you're going to make a clean choice. But the other thing is portfolio owners generally are accountable to investors in a way that single building owners are not. And ESG reporting requirements and the demands of those investors are increasingly that their own portfolio decarbonize. And so if you want to make your portfolio more attractive, you're going to have a story and a plan that you can sort of act on to reduce the carbon footprint of the emission. This is also where you see people buying up companies that have negative carbon or investing in carbon offsets. So your building as an investment or your portfolio of buildings can be part of that story as well. In complex buildings and campuses, we think the tax credit programs as they relate to one another hang together really well and provide new opportunities for disaster recovery and business continuity, as well as the decarbonization and the energy business case. In heavy industry, the carbon capture that I mentioned before, as well as some manufacturing tax credits that are not specifically related to clean tech, plus the clean tech ITC, plus significant government funding from other programs, create an environment where heavy industry is going to get subsidized like almost 100% for their decarbonization efforts in a lot of cases, which is controversial in the sense that extremely profitable companies getting paid to do this might be hard to take, but the business case to decarbonize purely on a dollar standpoint just isn't there. So that stimulus is vital to getting those decisions made. On the manufacturing side, again, a number of ITCs, as well as programs that are designed to basically to enhance our domestic manufacturing footprint, particularly in advanced and innovative areas like clean tech and others. And then lastly, utilities and pubcos get their own incentives, but they also get the tax programs we mentioned here. And if they're structured correctly, meaning the owner of the asset is a taxable entity that is actually owned and controlled by one of these tax exempt entities, there's quite a lot of interesting stuff that can be done. So, and in a lot of ways, particularly for geothermal, these types of entities are ideal. They own a lot of real estate. They consume a seemingly limitless amount of heat and produce a lot of carbon in a process that doesn't really have to produce carbon. So frankly, a really good use case. And in order to get the benefit of all the programs, you have to be a bit more planful in your approach. So how do we do this? So if we fast forward to the world where this is legislated, from planning the project through to, I guess, putting the shovel in the ground, we're providing planning and advisory support. We're basically making sure that you start as you mean to go and you know full well how much of this is going to get funded from ITCs and other programs. And in the case of grant programs, making applications and securing funding for you before the shovel goes in the ground. Once the project is complete, we're preparing the claims for the tax programs that we identified in the planning stage, and getting the follow-on benefit net of the grant funding. And then, of course, one of our core competencies is defending this if the CRA wants to review it. So when we go into the planning stage, we're going to make determinations with our clients on whether we're going to be aggressive or conservative, what we think is going to happen. And then when we prepare the claim, same question, are we, trying to maximize what we can get and we're going to push the envelope, or are we trying to just get this done and move on to the next one? That has a direct implication on whether we're likely to be reviewed. When you're working with a consultant, you shouldn't fear the review. You should just know in advance whether you are to expect it. And we'll be able to sort of put on the table like what the bookends are. The minimum you're going to get, the maximum you're going to get, probable outcome of the review. I think when people think of CRA reviews, it's like getting audited on your personal income tax, like incredibly stressful and it feels uncertain. When you're working with us on a corporate level, it's more like it's a brick in the wall. It's just something we have to plan for and execute. And myself and my partner, Louis, who is actually doing a CRA review as we speak and was meant to be here today, are two great contacts for this. Feel free to reach out to either of us. If you speak fluent French, Louis definitely is the guy to go to. But feel free to come to either one of us, and we're happy to support.
Thank you very much, Andrew. That was fantastic. I mean, for those of us who perhaps saw the Bloomberg article last week, Bloomberg very pointedly referring to Canada as the second best place in the world, of course, after the US for renewables due to the tax credits. I mean, what an exciting time for our industry. Our next speaker is Matt Tokarik. He is one of Canada's leading authorities on geothermal energy systems. Matt is an associate professor at Toronto Metropolitan University and at McMaster University. Matt also sits on the steering committee for zero carbon building standards with the Canadian Green Building Council, which is the body that administers LEED. He is a professional engineer, is a founding member of our company, and we are very proud that he can still make the time to be our president here at Subterra Renewables. Matt, you're going to take us through how geothermal energy works and how it applies to buildings. Please take it away.
Great. Thanks for the introduction, Kareem. That was very well said. Just to introduce one more piece of Subterra, I know that Kareem gave us a brief introduction at the start. Subterra is a geothermal utility company. I want to point out the fact that, very importantly, we're vertically integrated with over 60 drills in our fleet. I heard one of the points that Andrew said regarding the prevailing wages, that they've been specifically excluded for geothermal, which is great. But I do want to mention, if in the legislation that decision changes, that we've got direct control over those drills and over those wages. So should that come out on the other side of the table, we're going to be in direct control of that and have the ability to make that change. Okay, so I think what I'm going to do here is sort of take the intro that Andrew gave us and try to zero in a little bit more into the building sector and specifically into the geothermal technology and how these ITCs are going to apply to the conversation of carbon reduction in buildings and in geothermal. So I want to talk about three things primarily with this slide. The first is to set the table a little bit with the problem. So as Kareem mentioned at the top of the hour, we're in a climate crisis. There's been a lot of talk about this, particularly around things like the Paris Accord, where we set a target globally for net zero by 2050, which has been adopted by countries, including Canada, the US, et cetera. And when we look at the carbon inventory, you might be surprised to know, but in cities and major metro areas like Toronto and New York, that buildings actually account for about 60% of the greenhouse gas emissions. Many folks think that it's transportation, but buildings are actually the largest contributor when we're talking about cities. If you zoom in on that 60%, the largest factor there is actually building heating, and this is significant. Up to 3/4 of the carbon emissions are associated with building heating, and really what we're talking about is direct fossil fuel emissions on our sites. In most of our buildings, the status quo that we've been working with is to fire natural gas, fuel oil, propane, et cetera, to heat our spaces, to heat our hot water. And so this is really the problem that we're trying to tackle, particularly when we're talking about geothermal, as we will be doing for the next few minutes. So that's the problem that we're trying to solve for. And as we've seen, the pendulum has started to swing. Government policies, social pressure, a lot of drive and support has now been put behind getting our buildings to zero carbon and getting rid of that GHG in our atmosphere. So again, that pendulum has really started to swing. The second thing I want to talk about here is some of the carrots. This is a good, again, segue from what Andrew was talking about, but there's a lot of good reasons to be doing this right now. And if you're not doing it now, you're going to be too late. But to mention a few of them, I want to start talking about some of the cost benefits of making our buildings carbon neutral, and again, particularly as we talk about geothermal. So the first one are some of the investment-related items, some of the capital pieces that are very helpful. There's a couple really interesting options that are going to help us here. The first one is some of the financing that's going to be available. Companies like ours who are going to be able to provide capital for these systems. We'll talk about how the energy as a service product works in a minute here, but we'll actually join the capital stack and be able to fund these projects directly. Obviously, the ITCs, which is what we're here to talk about today, is another really impactful piece. ESG dollars are now being more and more targeted on these clean energy systems. They're moving away. If you speak to the investment groups and the investment committees, they're saying we no longer want to be investing in fossil fuel-based technology, and we're moving strictly to clean tech. And then even things like CMHC, if anybody's applied for a CMHC piece of funding, they've got really good financing terms for carbon reduction related systems. So from a capital standpoint, there's some really big advantages to building green. From an operating standpoint as well, there's large savings. The way that these systems tend to work is that there may be some capital investment up front, which again, we can reduce through these measures. But once you've made that investment, there's a large OPEX savings over the course of the life cycle of the building. So not only if we can get those CapEx savings reduced, can we have a lower initial cost, but over the life cycle of the building, with these green technologies, we can actually see an OPEX savings as well. Another big one that we're really seeing being impactful in the market is the approval process and the sales process moving much quicker. So the buildings that have these green systems, these carbon reduced systems, are moving through the planning process faster, and they're selling faster if you're a condo. New buyers in the market today, if given the option, they're always going to favor the green building, the green product, and they're really starting to chase that type of building product. And then the last piece I'll add here is the market that's now opening up for carbon credits. So as we're starting to generate these carbon savings and these carbon credits, there's actually going to be a secondary market to start trading and selling. So there's going to be another added benefit from a financial standpoint there. So the third point here I want to make on this slide is what happens if I don't do this, right? The building industry, unfortunately, tends to have many laggards in it who say, I don't want to be the first guy to try this. I don't want to be the bleeding edge. And I've been building this way for 30 years. Why am I going to change now? Well, we've gotten to a point now where it's actually going to cost you if you don't start to adopt these practices. One of the big ones that we've seen in already is the carbon tax program from the federal government. Right now, the carbon tax sits at $60 a ton and is expected to go up to $170 per ton by 2030. So if you say, okay, well, what does that mean? I don't know how much a ton is. This gets charged on your Enbridge bill. So you can go home and take a look at your bill. You'll see they'll convert it to dollars per meter cubed or per foot cubed. But what's going to happen is that by 2030, the cost of natural gas is going to effectively double because of these carbon taxes. Right. I'll say that again. The cost of natural gas is going to double with these carbon taxes. So if you're sitting there thinking that your building can still use a fossil fuel burning system, it's time to start thinking again, because you're going to be locking yourself into that system that's going to start becoming really, really expensive and volatile. Right. As these systems use more and more energy, they become more susceptible to the volatility of that pricing. Another big one that Andrew touched on a little bit, and I'll elaborate on because this is sort of in my world, is the building permit process. And particularly for the folks who are sitting in Toronto, the program that we call Toronto Green Standard has really put some tight regulations around what we're allowed to do. The way that this program works is that it's going to get more and more stringent over the next decade, to the point where at 2030, we're no longer going to be able to build the way that we are, and in fact, we're going to have to be building to net zero standards. So that means, if the stuff that you've been doing for the last number of years has been working to get your site plan approval, it will no longer work in the next couple of years to get your site plan approval. So forget the cost of your building operating. You're not even going to be able to get a permit to build your building. So that's going to be really impactful. There's also some other laws, particularly south of the border in New York. Local Law 97 has put a cap on the carbon that buildings are allowed to use starting in 2024. And we're expecting that there may be something that's going to come north of the border shortly as well. I'll just add one more piece before we jump from this slide, which is another thought around future-proofing. In speaking with some of the building investor types in the city, the REITs, they're basically saying that this is becoming table stakes. They're saying, not only are we not going to build to a clean standard, particularly geothermal in the conversations that we're having, but we're not even going to buy buildings that don't have these types of systems. They know that in the next 5 years, 10 years, they're going to have to rip these systems out, replace them, or when they go to sell them, it's going to reduce the value when they put those on the market. So again, the point I want to make here is that now is the time to be thinking about this. The pendulum has swung, and we need to be building our buildings with future-proofing in mind. Okay, so as we zone in a little bit or zero in here around the specific clean tech ITC, I'm going to get again to the geothermal specifically, but I just want to mention that it's not just the geothermal system, the ground loops that are going to be involved in the capital calculation of these systems. It's the integrated system from top to bottom. So that is going to be the ground loops. That's going to be the risers, the ductwork, the heat pumps, the fan coils in your suites. Sort of everything from top to bottom that's considered part of that system to make it work. This is even going to extend to things like electrical upgrades if you need to do that to have these systems installed. Everything that's included in that definition of system is going to be up for grabs in the ITC calculation. And then any sort of auxiliary items that you have in your building. Obviously, this graph or this picture is showing a little bit beyond the building. But when we're talking about our clean tech ITCs at the building scale, anything that's attached, be it solar, be it solar hot water, battery storage, etc., that stuff is all going to be eligible for your capital calculation on what qualifies for the ITCs. So as we continue to zero in here, I want to talk a little bit more about geothermal, and I'll just quickly mention for anybody who's less familiar with technology how this works. Effectively, what we're doing is creating a thermal storage battery with the ground. So the ground below all of our buildings that we're all sitting in here today has energy stored in it. And if you connect your building to that ground, that heat is up for grabs. So the way that these systems work is we take that heat that's sitting in the ground, that's stored in the ground naturally, generated from the sun originally, and we use it to heat our buildings. Okay. In the summertime, we're going to reverse that process. This process is cyclical and it can go back and forth. And we cool the buildings and store that heat in the ground. Okay, so in the wintertime, again, we take the heat, put it in the building. In the summertime, we cool the building or remove the heat, and we store it back in the ground. And over the course of the year, we end up with this thermal storage battery concept where we're using that volume of soil below the ground to heat and cool the space, to thermally couple the building with the ground. Sorry, Kyle, one more just to touch on this before we move over. One really important design consideration that impacts a lot of the financial considerations that we're talking about here is the way that the design of the building is different. Most notably, in doing this geo exchange system, we remove the mechanical equipment, the conventional equipment. This is a boiler, a chiller, a cooling tower from the mechanical penthouse space. Okay, when we take all of that equipment off the roof and we effectively bury the same function in the ground, we've now freed up a lot of space. We have to rethink the way that we're designing our buildings. We free up this space, and now that space can become usable, sellable, leasable, outdoor amenity, etc. But the most valuable space in our buildings is unlocked. So that's another really, really impactful thing about these geothermal systems in our buildings. Just to sort of touch one more time upon some of these benefits, going through the numbers on the left here. As I mentioned, when we rethink the design, we're freeing up a bunch of that space. Kareem will show an example here of sort of what that looks like. But again, if you're in Toronto, for example, the condo market here is selling at $1,200 to $1,500 per foot. So if you start freeing up space that you can sell, you can now start to realize a very significant capital gain or a revenue addition, I suppose, in your condo sales. And then to the points about energy savings and carbon reduction, these geothermal systems are super efficient. They're highly energy efficient because they're being driven not by fossil fuels, but by a heat pump, which has a greater than 100% efficiency. And because we're removing that fossil fuels, they've got a really, really impactful carbon reduction up to 95%. Again, like I said at the start, that 60% of buildings emissions, of which 3/4 is associated with space heating, is directly tied to that fossil fuel burning system. So when we can remove that, we have that really, really big savings in fossil fuels. Okay, so that's sort of how these systems work. And as we start to think about specifically some of the economic benefits of these geothermal systems, I'll just touch briefly upon how our energy as a service model works. So this is Subterra acting as a utility. Effectively, what happens is we will join the capital stack. That creates a savings for the developer. So again, that whole design shift has a really impactful outcome here, where you as a developer would have had a pro forma that says I'm going to have to buy a boiler, a chiller, a cooling tower. You now get to scratch those items off your pro forma, so you have a capital savings. We will join the capital stack and put up the capital to install the geothermal system. So there's that initial benefit. And then because these systems are so much cheaper to operate, again, there's the energy efficiency savings from utility dollars. There's reduced reserves service and maintenance and make up water from removing those big moving parts on the roof, the operating savings are large. And so what we end up with here is a savings at the front, a capital savings for the developer, an operating savings for the end user because of the OPEX reduction, and of course the green benefit. So there's a very large win-win-win outcome here of these energy as a service contracts. Typically, these things last for 30 years, and they've got a fixed rate. So we agree upon the rate at the start. So again, there's a hedge against utility volatility. Just to give a little bit more of an example visually here of what I described in the last slide, we've got a comparison here of an operating cost for a conventional system, which we've dubbed baseline here. So this would be our natural gas based boiler system. On the right-hand side, we've got our geothermal system. And this is what I describe as the carrying cost for the system. So this is everything from the utility input through to the capital reserves, maintenance, repair, et cetera. You can see that it's cheaper on the geothermal system. Even if you're having to repay some of the financing fee, we can generally get to about a 10% savings because these systems are so efficient, capitally efficient to operate. And then just speaking to the cost efficiency and certainty around this program, I'll just mention two things. The first is that we can enter these agreements and we can start to talk about these contracts effectively at no cost and no risk to the building developer. We will do a feasibility study, which includes a desktop review and a test borehole to understand what's in the ground and for thermal conductivity up front to confirm the numbers that we've assumed. We're going to build a financial model to understand how much that renewable energy fee needs to be, and if we can't generate those savings that we've just described, then we won't move forward with the contract. Once we do understand what that number is going to be, we're going to lock that number in. There's going to be a fixed fee over that 30-year period. So again, the risk becomes very low to do this, and we can enter a contract without risk and again generating those carbon savings, which is what we're here to do. Okay, and then the final piece that I'll touch on before I pass this back to Kareem is the process. So you may have heard the sustainability types describe this before, but designers always want to get into the building and into the design process as early as possible. It's difficult to add a geothermal design if you're right about to go into construction. As I mentioned before, there's some design considerations that change in terms of spacing. So when you're thinking about your programming with your architectural designer through schematic design and concept design, usually this is zoning or before zoning, we want to make sure that we're involved in the conversation so we can help lay out the building correctly. And then very importantly for, again, the folks in Toronto specifically who are targeting the Toronto Green Standard, there needs to be the notion of a geothermal system in your site plan application such that you're going to meet your energy intensity and carbon intensity targets. So the earlier the better when we get involved, and very specifically before we try to be in before zoning.
Thanks, Matt. So I'm going to go over a couple of quick slides, a real example over here, a case study, if you will, from a development in downtown Toronto. And I just want everyone to know, however, I know that we're running short on time. I'm not going to take a lot of time over here because I do want to open up the floor for questions. I realize that we've scheduled this to end at 11 o'clock, but if you do have an opportunity to stick around, we will allow the questions to come through and we will go ahead and answer them to the best of our ability. So just before we get to there, the few points I want to emphasize, and again, using one of our own clients as an example, is that adding geothermal heating and cooling, geothermal energy to your building, it's not just the right thing to do. It's also the most financially lucrative decision you're going to make, all things considered, considering everything we just spoke about. And one other note on that topic. It is the most constant and resilient of all green technologies in the world. You are literally using the earth for heating and cooling. It will outlive the age of your construction, the age of your development, the age of your building. It is not going anywhere. So on that note, Let's go through a quick case study. A 300-unit condo in Toronto, 255,000 square feet. There's a lot of carbon offset over here. Of course, it's the equivalent of taking about 430 tons of CO2 out of the atmosphere every year. Now, the avoided costs that this particular client had by not having to put traditional or conventional HVAC equipment into the building is almost $1 million. There's also, as Matt was mentioning, an additional pickup of anywhere between $2.9 and $3.6 million due to now having this very beautiful penthouse available that otherwise just would have housed mechanical equipment. Now, in this particular case, and I want to emphasize this, our model, our aura, if you will, our product, our energy as a service model, it worked prior to these tax incentives being announced. So we're not doing anything different. We are still coming out here and acting as your geothermal energy utility, your geothermal cooling and heating utility. We are still offering value in the case of a condo, let's say, to the homeowners that are going to be moving in. We are still going to be cheaper than conventional heating and cooling, even without the tax incentives. So what are we doing with the tax incentives? We are not greedy. We would like to share this. We want to give this to you as an incentive to use geothermal in your buildings to ensure that this is a no-brainer every single time. And just to point it out, in this particular building, the value of the tax incentives is $2.1 million. You can go to the next slide, please. A lot of this is saying the same thing, but just with a visual example. If you look to the right, the geothermal field itself, the bore field in the mechanical room, is going to generate about $1.1 million for this particular building in tax credit. That's tax credit that we could keep, but we are giving to you, the developer, in order to either go ahead and build further amenities for your folks, in order to otherwise reduce costs, or in order to help in your sales process. Now, keep in mind, though, that there's more to this than just putting the bore field in place. You're no longer putting HVAC equipment, traditional or conventional HVAC equipment into your building. Now you're putting heat pumps, for example, possibly heat pumps into your suites. This particular building is putting heat pumps into its suites that requires some ducting and some additional electrical work. All of that qualifies for the tax incentive. Not just the heat pumps, but everything that was necessary to make that system a reality. I want to emphasize that because the tax incentive comes from both ends. And had this particular building just been putting in a traditional HVAC system, traditional chiller and boiler system, not only is that an ongoing cost for a very long time for its residents, not only is it going to cost penalties in the future, but none of this would have been available to them. Now, if you go to the last slide, please. And I promise this is the last one that we're going to turn it over for Q&A. This is what I was pointing out before. Matt talked about this in great detail, but we are getting, like, I've been in a lot of mechanical penthouses and the views are beautiful, especially in Toronto. Gorgeous views from the mechanical penthouses. Nobody else gets to see that. Just folks like us who, for whatever reason, like to go visit those places to ensure that everything is working correctly. If this becomes an area that you can now market, an area that can now be resided in, whether it's an amenity space, for example, I've seen that, or whether it becomes a residential part, it is a very, very valuable part of the building. And at $1,200 a square feet, that's an additional $2.1 million pickup. And on that note, I would like to thank you all for spending time with us to learn about these exciting tax credits that are affecting our industry. We will be moving into Q&A now, but I want to point out a couple of things. First off, at the top of the Teams window, there's a little kind of section called More Actions. In there, you'll find a button for Q&A. If you click on that button and you type in your question, it will come to us, and I will direct that question accordingly either to Matt or to Andrew so that we can get your question answered. Secondly, this webinar is the first in a series that we are putting together to disseminate best practices and cutting-edge information regarding our industry, regarding renewable energy for everyone who wants to hear it. So we will be announcing our next webinar in the coming weeks. Please stay connected to us so you don't miss out. And with that, let's go ahead and get it right into the questions. So the first question I have, is my project eligible for the incentive if we are using geothermal and breaking ground on construction later this year? I know the short answer is yes, but Andrew, if you don't mind.
Absolutely.
Short
It
answer.
hasn't been legislated yet, so there's nothing to claim, but it's in the future, so you're good.
Okay, wonderful. On that note, though, had we started breaking ground right now, or for some of our projects, for example, that were where the bore field, for example, was done earlier this year, or in some cases late last year. I know you already mentioned this, but do you mind just maybe giving some comfort around the availability of tax credits for those, the grandfathering, if you will?
Definitely not grandfathering, which has a specific meaning. So sorry to correct you there, but the gist of it is if it's not like finished, meaning the building owner owns it, like that you've tossed the keys to the next party by the budget date, you're good. So work that's been done, stuff that's in progress, it's all good. But if you took possession, you own the asset on March 27, 2023 or before, not eligible. So all these in progress items are good to go.
Awesome, exciting. Okay, let's see. At what stage of development process do we need to engage you for geothermal? Matt did speak on this, but we went through that slide very quickly. Matt, do you want to take that one?
Yeah, sure. The short answer again is the earlier the better. You want to make sure that you've got the right planning from a space standpoint, from a design standpoint. Some of the triggers that we look for very specifically, again, are space programming to make sure that we've got the right reductions in mechanical penthouse and layout in other spots. Number two is if you're doing a mechanical brief with your mechanical designer, we like to make sure that we've got geothermal mentioned there. And when you're submitting for your site plan application, this is Toronto specific, you should have involved in your energy model and your mechanical brief the notion of a geothermal system. So again, the earlier the better, but those are some very specific flags that we typically look for.
I have another question over here. And Andrew, this is probably for you. What is the timing for the ITC to be applied as income for a project that could be 2 years plus after installation of the geo-exchange solution? So let me just rephrase that. If, for example, you have a new development that is likely not going to have any taxable income for a couple of years, maybe longer, but did apply for the ITC and does qualify for the ITC, how do they claim the ITC if they don't have taxable income?
First of all, it's refundable. So if you are eligible to pay tax, you just don't pay tax because of the situation with your, costs and revenues, then you get money, like they write you a check. If you are tax exempt, you don't qualify. Answering the other part of the question, you can carry forward tax benefits 20 years and carry them back 5 years. So you can refile your taxes from prior years going back 5 years to recover taxes paid if your tax situation warrants that. But that is all of what I just said is how it usually works. All they would have to do in the legislation is say, actually, we're only going to let you carry it forward 5 and you can't carry it back, and then or something. And then that would be the rule for that particular ITC. So generally carry forward 20, carry back 5.
Wonderful. Thank you. Matt, this is probably for you, but I mean, if you disagree, Andrew, and Kyle, if you want to opine on this one as well, is there any way for developers of residential condominiums to take advantage of these ITCs? These companies would not maintain the ownership of any geothermal equipment once the building is registered and turned over to the condo board. So just to let me rephrase that, can a developer of a condo take advantage of the ITC if they're not going to otherwise maintain or own the geothermal energy system on a forward basis?
So I'll field that one.
Please.
Short answer is probably. So basically, if you own the asset, you're the developer, there's a period of time where Subterra has finished their work and somebody has to own this thing. And the condo corp has not yet taken possession. Usually you're renting units to people at that time. Heating is being provided. There's no question that the geothermal solution is in and working, yet the condo corp doesn't own it. So in that window of time, you should be able to claim the ITC. One of the details that has not yet been legislated is there a minimum length of time you have to own the asset in order to be eligible? On the manufacturing ITC, there is. And the very simple reason is they don't want you to buy equipment, make a few heat pumps, and then use the same equipment to start making boilers that burn gas. and have collected the money in between. So on that ITC, they're solving a problem by having that clause, but that clause is very common in ITCs. And it's very common in how capital assets are treated in the tax code and how they're depreciated. You're not really allowed to buy it for one thing and then use it for another thing and reap the rewards. That's not really what would be happening in the case of a property developer claiming the tax credit. And also, it is stimulus meant to get people to adopt these solutions. So there's a logical case for why the developer would be able to claim, but hold me to it after the ink is dry and we'll tell you definitively.
I do want to point out that for anyone who is going energy as a service with us, we obviously will continue to own the asset for all that period of time. And just as I had mentioned earlier, we are very much amenable to ensuring that the tax credit goes your way. So we'll figure out exactly on a case-by-case basis how it is that you want us to treat that.
Well, so actually, let me make another point that answers the question Bob just asked as well. So in a situation where the right people don't own this thing, but we want to get the tax credit, whether that's because of the contract terms with Subterra or some other thing, you create an entity, a legal entity that is taxable for the purposes of owning this asset. And then that entity claims the tax credit, which generates a refund, which you participate in as the owner, maybe a municipality like Bob, and can take the money out of. So, this is somewhat complicated, but the quantum is usually worth it. Like, again, if you're a municipality, it's probably not one and done. It's not $2 million tax credit. It's a move towards green. And this entity that's going to own these assets is going to own a bunch of things and possibly sell energy and generate tax. So structuring is important, and the tax credits are only one facet of that. But, with virtually every scenario, you can get to a place where you can claim the tax credit.
Okay, thank you for that. There is, I'm trying to get to as many questions as possible, folks. So I'm not trying to gloss over any. I'm trying to see if there are similar ones so I can ask it. So there's a question over here as to, this is a quick one. I'll answer this one. The question is energy as a service an Ontario phenomenon, or can it be offered in other provinces? The short answer is we offer, I'm sure others do as well, but we definitely offer energy as a service, our utility model, both in the US and Canada, anywhere where we can make it work. Now, this is a great question. Will geothermal projects qualify for production tax credit or only the ITC?
There are no production tax credits right now. So any production tax credit, you know what? We're talking about Canada here. I just realized there's a possibility there's a multi-jurisdictional audience. Everything we've talked about here is Canada. Taxable Canadian entity, building is in Canada, solution is in Canada, all Canada. PTCs are part of the IRA in the United States. So this isn't an either or proposition. This is like wherever you are, you have to go with the law of the land.
Yep. And I do want to point out to everyone, we will likely be putting together a US focused ITC webinar in the coming weeks. So stay tuned for that. Here's another great one, probably for you, Andrew. Can the income tax credit be registered on title, or how can they be transferred if the property is sold?
I'm going to answer that question the way I'm comfortable answering it because I'm not a real estate lawyer. Basically, the capital asset goes onto the books of the owner when it becomes a capital asset, meaning the work is finished and you've taken ownership of the thing, which does include more than just the physical equipment. It's the landed cost. So installation and things like that are part of the asset. So depending on the time in your construction cycle and in all of that, somebody's going to own it whenever it's finished. That's who claims the tax credit. If they don't claim the tax credit and they transfer the asset to someone else, they can claim the tax credit. It's just in most of these scenarios, you're working towards an end game where somebody owns it who's not taxable. So you want to obviously claim it as early as you can.
Thank you, Andrew. There's a quick question on the case study I went over, so I'll answer that right away. The question is whether or not the numbers in the case study was based on a developer installing their own geothermal energy system or based on one in which they're using our utility model. And the answer is it's the latter. It's based on one using our utility model, our energy as a service model. I have one of the earlier questions that was asked. This is a great one. I think it's really worth being very clear about this. Matt had mentioned that the ITCs would cover duct tape, ducts, pipes, electrical upgrades, etc., when using a system like geothermal. Would this still be the case if we had a gas-fired backup in the mechanical plant? For example, if geo cannot cover 100% of the building's load?
So the tax code doesn't care about the building. Basically, the question you're answering is it part of this capital asset? So there's a lot of duct work that goes into the point at which heat is being created by the capital asset. That's in. There's a lot of duct work in the building. That's not part of the geothermal solution. That's part of the building, which is a different capital asset. And so then when you're asking the question of the landed cost, what work did I need to do to make this happen? Some level of electrical work to get the capital asset in is going to clearly be part of the landed cost. And depending on what else you're doing in your project, probably some level of electrical work being done is actually being done on the building, not on the geothermal solution. So this is basically an ad for why you use a consultant to figure this out, because it's a lot based on precedent and a lot based on logic and reason. But to give you sort of a more simple example, let's say you were putting in a solution that caused you to have to reinforce the floor in an existing building. And you'd say, well, I'm not going to do this floor unless I buy this thing. But you do the whole floor because you're like, why wouldn't I? I'm already in there doing floor. So you're probably going to say, well, the whole floor is now part of the solution. And the CRA is probably going to say, what percentage of the floor is sitting under this piece of equipment? And then you're going to say, well, if we only did that part, it would collapse. And this type of back and forth is what determines what's part of the geothermal asset and what's part of the building. So we don't want to pack it with things that suspend credibility, but we also want to make sure that costs that you had to incur in order to do the thing the government is trying to incentivize get captured. And when you then say, instead of an amenity, I'm using solar on the roof, and now there's electrical that covers more than one thing and building controls that are involved in how I use all these things, wrapping that around what's part of what asset and what I'm getting tax refund for gets complicated fast. And you want to make sure you get every dollar. So
that was wonderful. Thank you, Andrew. There was a question, I'll answer this one quickly. There's a question on the tax credit and where it's going. Just for those who don't know, currently the tax credit for 2023, my apologies, the carbon tax. The question is regarding the carbon tax and where it's going to go. Currently, the carbon tax sits at $65 a ton. By 2030, it is going to be $170 a ton. So we're all on the same page. It hasn't been announced what's going to happen after that. The expectation is it's going to continue to go up. Now, great question over here. What is the process for retrofitting a building that currently has a fan coil rather than heat pumps? Does that mean that all the units have to be changed to heat pumps?
The answer is no, you don't have to change all of your units to heat pumps. You would just have to have the correct central heat pump to distribute that hot water and cold water, chilled water to your fan coils in the units. But you would not have to retrofit every unit.
Thank you. Quick question over here is also, I'll answer this one. Are you estimating that the geothermal system operational cost is lower than the cost of conventional system without the carbon tax? The answer is no. When we're estimating that we are going to be lower than the cost of conventional heating and cooling, it takes into account that carbon tax. That carbon tax is, as Matt and both Andrew and Matt were mentioning earlier, that really is the stick, if you will, that is continuing to go up, that is making a choice not to go renewable a very, very expensive choice. Okay. Here's a good question, and this is probably for you, Andrew. Does the ITC apply to any enhanced envelope elements to support zero carbon design or performance? For example, glazing performance or insulation?
Definitely not glazing and insulation, because those are going to be considered part of the building. To the extent that you have a wall for solar thermal energy storage, you can claim a good chunk of that, according to what we've read. To the extent that you have a wall for like literally a solar wall for generation, definitely you're going to be able to claim that. But basically the case you have to make to the CRA is it part of this storage solution or generation solution, or is it part of the building? And in the material that they've already sent out, they've said, don't talk to me about envelope and windows. So they're trying to nip that in the bud a little bit. But you know, the industry continues to innovate, so maybe there'll be new products that challenge that assumption as time goes on.
All the more reason for geo.
Yeah, there you go.
I have a question over here, a really funny one. That we are all being thanked for giving this presentation from the International Space Station. So you are welcome, by the way, to the person who asked that question. And then the more serious part of the question is, when do the carbon credits kick in? Carbon credits, okay. When do carbon credits kick in, and how are they shared with the developer? I think what you're asking is, at what point is the ITC become available? So actually, if you don't mind maybe speaking to the timing, the expected timing, I should say, Andrew, regarding when an ITC would be available. So now just to kind of put some context around that, for example, are you waiting until a specific time in the year to claim the ITC? Is it when you file your books at your fiscal year end? Is it when you do your reporting, or is it at any time?
It's part of your taxes. I mean, there's probably going to be significant extra paperwork, but it's going to be submitted with your annual taxes, and you become eligible for it. Like I said before, when it transfers ownership, you own the capital asset. The end of that year, when you do your taxes, is when you would file.
Wonderful. And the other part of that question is how it's shared with the developer. I think that's a great part of the question. I just want to maybe expand upon it a little bit, because there is a very clear delineation that's being established so far between how the US in the Inflation Reduction Act is treating the investment tax credit and how we are. My understanding is that in the US, the IRS has like a marketplace of sorts where you can effectively turn the ITC into a commodity and sell it. Andrew, can you maybe comment on how Canada intends on doing that? I mean, it may not even apply if Canada is going to otherwise possibly offer also a rebate, but is anything to that effect maybe coming to Canada, in your opinion?
Nothing that we know of. Nothing as cool and interesting as that. It's actually like typically Canadian, which is to say very straightforward. If you own the thing, you claim the tax credit and it nets from your taxes. And if it either means you pay less or you get a refund, full stop. But as far as like sharing the tax credit, I think it's probably better to think of it as like money. And so the structure of the contract that you have with the party who would also potentially benefit from the tax credit should just account for this new flow of cash. Because you don't want to change who owns the thing just because of the tax credit. It's more like you want your commercial arrangement to reflect the fact that the tax credit is coming, in my opinion, because otherwise you're doing a bunch of unnecessary legal work when all you really care about is getting the extra cash.
Yep. Wonderful. Thank you, Andrew. I think this was answered earlier. There was a question regarding evaluating how the ITC credit applies to a project. Just for the person who asked that question, one of the things that was being asked, one of the answers that Andrew was giving earlier was regarding the kind of the demarcation, if you will, or the applicability of assigning the ITC to various components that otherwise were needed in order to have that renewable asset, for example, put into a building. So basically, on that note, get in touch with Andrew if you want to learn more about that. But again, just to summarize, anything that is otherwise needed, net new, in order to ensure the renewable asset can operate within the building is ultimately going to fall within the ITC. Here's a technical question, and actually, Kyle or Matt, if either of you could take this one. What would the electricity consumption amount and cost be for a power pump or a fan in the example of the geothermal system? So in other words, moving to heat pumps, for example, in suites, what is the additional cost and power consumption associated with that? Just obviously high level. And can I offset that power cost with solar, whether it be rooftop on the building or virtual net metering from a power purchase agreement to make my power OPEX $0?
Yeah, I'm happy to take that. I mean, the short answer is with the heat pumps, a heat pump to a fan coil will consume more electricity. But wrapping that to an earlier point, that might involve slight electrical upgrades from what you otherwise would have had, which then you can start lumping back into that case if that's part of the system, and therefore now that's more eligible for the credit. Um, we're happy, to do any kind of an analysis to show you it's not an exponentially larger electrical load, but compared to the fan coils, yes, it would be a bit more. Now, the actual system in the basement, it's a circulation pump that's driving fluid. It's very little electricity from the system itself. Perfect.
Sorry, just to add on that, the electricity will go up a little bit, but the natural gas disappears, and as a net effect of both the electrical and the gas input, you're going to have an overall reduction in total energy. Even though the electricity is going to go up a little bit, the total will be a reduction.
Thank you. I have a question. This is a very interesting one. I didn't see this one coming. I certainly don't have the answer to it. In the event a development is on environmentally risk assessed lands, could this development still qualify? I don't know who wants to take that one, but
There's not enough information for me to say anything from a tax standpoint. That seems to be more like a legal question. But from a tax standpoint, if you are not tax exempt and you buy the capital asset, you should be good.
appreciate that. Great question, whoever asked that one. Great question. Our view, of course, is that just as Andrew had mentioned, that regardless of the development status, you're putting in something that is part of the ITC. So you're going to get the ITC.
That's right. Yeah.
If the ground loop and inside geothermal heating and air conditioning system are owned by a third party who collects the ITC, the building owner or the owner of the integrated geothermal system. So, I mean, I can like we kind of spoke about this a little bit, but just to clarify for this particular question, it would be the owner of the system. If it was a utility system, energy as a service offered by us, then we would be the ones applying for it. We would be the ones then deciding with you how it is that we structure that into our offering to you, whether it is that we're effectively giving it back to you or if we are doing something else with it in order to enhance the value proposition. So definitely get in touch with us regarding that. It's going to be on a case-by-case basis.
I'll chime in there and say you could probably make it go the way you want according to the commercial terms. So
Thank you.
When you're the owner, are you providing it as a capital lease, meaning the other person is really financing it and taking possession at the end? Because then the case can be made that you're the owner. But really, eyes wide open, when you get into the commercial arrangement, just figure out how much it's going to be and agree how it's going to be applied, and then sort of leave it from there. When the legislation is final, there will be a path of least resistance that we'll advise on, and I would suggest that that's the way you should go, and then talk about the asset value on the commercial terms. And I'm afraid with that, I have to drop off, but I know that there are tons of engineering and technical questions that I add zero value. So I know you guys will continue going. And in the meantime, like, my email was on the other slide. Anybody feel free to reach out to me, and thank you for the opportunity. I just have to jump. So I'll leave it there and sign off.
Thank you so much, Andrew. Thank you kindly for your time.
Thanks, everybody. Bye-bye.
Folks, we'll go through a few more questions, mostly on the technical side, but just to chime in on what Andrew just said, I think it's very important to note that every single energy as a service offering that we have made to date, certainly every single one that we are entering into, our standard utility model for condominiums is structured as a capital lease. Effectively at the end of it, we transfer ownership over to the condo. So it kind of looks like, from a tax perspective, as Andrew was saying, that it's effectively, a finance solution. So it becomes very easy in those situations for us to either apply on your behalf, help you apply for it, or for you to simply apply for it yourselves, and for it to never come to us. When it's an operating lease, that's when we have to have a little bit more structure required, and we need to go ahead and decide how it is that we need to deal with this in terms of the final offering and the final price. And I only bring that up because it's almost never going to apply to condominiums. Rarely is it going to apply to apartment rentals, but sometimes it may apply to hotels, for example, where operating leases are more popular. So I'm just going to pick out a few more questions, and then I'm hoping that we can wrap up by 11:30 at the latest. There are a lot of questions regarding whether or not there's a copy of this presentation or webinar, whether or not a recording could be made available. Of course, we will do all those things. We'll likely have a portion of our website where we'll dedicate on a forward basis to uploading these webinars. Give us a little bit of time to do that. It'll almost always happen about a week or so after the webinar. So in short, yes, you will be able to come back and review the materials at your leisure. There's a question regarding clarity on whether or not building owners currently are subject to paying carbon taxes. The answer is you are paying. Every one of us, I should specify, every single one of us is currently paying carbon taxes, whether as individuals or as corporations. You're paying carbon taxes in your gasoline, for example, when you're pumping at the station. You're paying carbon taxes on your Enbridge bill. If you look at your Enbridge bill, there's a very clear line item that states carbon taxes. There is actually some level of carbon tax even in your electricity bill. It's just kind of buried in the distribution charges because we still have quite a bit of electricity in this province that is coming from natural gas-fired peakers. So the answer is yes. If you are, as a building owner, responsible for the natural gas that is coming into your building, you are already paying the carbon tax.
Kareem, maybe I'll just add something to that point. Just the effect of the delta on the carbon tax associated with a unit of energy for natural gas versus a unit of energy for electricity. The delta, the spread is about 5 times the cost. So much greater on the fossil fuel side.
I have a great question for both Matt and Kyle. However, which way you also want to answer this. The question is that we have heard of systems failing in the past. How do you ensure my building will operate long term?
I'm happy to take that one. A large part of this is I like to think of geothermals. You're buying simplicity. So you're buying a system that has less moving parts, is slightly easier to manage and run. But the caveat to that is you need to watch it. And when I say watch it, someone needs to be overlooking it and looking, 5 months into the future, 1 year into the future, 5 years into the future. Because this is really a 100-year asset. This should outlive the life of the building. So when we talk about redundancies, this is where the feasibility, the design, the early stage is really important to make sure all the consultants on the building are really working together, making sure we're not over designing, but at the same extent we're designing correctly, so that when it's built, all the quality control, quality assurance is checked out, that this is an asset that's truly going to outlive the life of your building.
So Matt or Kyle, on that point, actually, and either one of you jump into this, please. Can either of you maybe opine or maybe give some context around certain assets that we have purchased, that we've acquired, and we had to come in and effectively save? Because there are geothermal energy systems currently out there that we have come in and tried to save the day on because they weren't maintained, and it became a nightmare either for the property manager or the building owner. So can either of you kind of maybe take us through an example over there?
I mean, a large part of this is back to the example of geothermals like a battery, and you got to take care of your batteries. You can't, if you keep overcharging, you keep discharging, you really stretch it to its limits, it's eventually going to start degrading and having problems. So when we've bought assets, the major thing we're always looking at and watching very closely is the charging and discharging that battery. The physical equipment, there's pumps, there's heat exchangers, pipes. That stuff is rudimentary and routine. It's changing out, changing in, that's standard stuff. But now when it's coming to, let's look at the battery life and temperature we use as a proxy for battery life. So making sure we're watching that, what's happening in the next 6 months. If we see something that's out of whack or something that's moving in the wrong direction, we can have that 6 months to take corrective action, rectify it, and make sure that 6 months time we do the same thing and keep doing that over and over and over, hopefully for the foreseeable and forever life of those systems.
Thank you. This is actually, this question comes up a lot, and I do want to kind of put it out. Can geothermal be added to existing buildings? In other words, can this be a retrofit?
In short answer is absolutely. To the earlier point, a lot of older buildings might have, there's certain things like fan coils. I know we've talked a lot about heat pumps, but really it's just a heat pump sort of needs to be involved, but it can either be one big central one or one that's, multiple little ones all throughout a building. So when we're talking about a retrofit scenario, the most important thing is we just come have a look at what's going on in the building, understand, the box of what we're looking at, and then look at how to implement what we can. And, if there's space available around, that might mean geothermal. There's massive advances going into, angled drilling techniques, for example. So instead of actually needing a certain square footage size of a parking lot to put in geo, you could drill it all from a central location. But there's also alternatives. We work very closely with waste energy technologies, which in short is using the sewage line from your building to provide heating and cooling. So there's multiple options that we can approach them at, but the short answer is absolutely yes.
And I just want to point out for everyone involved that with the waste with the waste energy or the devices that take basically your sewage and convert that to usable heat, they do apply. They do qualify for the ITC very explicitly. So I did want to point that out, that all of the technologies we're talking about all apply or all fall within that investment tax credit. All right, last but not least, and with this one I'm going to wrap up. What are my upfront costs to go geo?
Yeah,
So I'll give you. Let me just use the example we had earlier, Kyle. Maybe you can talk to this. The example we had earlier was a 255,000 square foot building, 300 units. If they were going conventional, or if they were paying out of pocket, for example, for a system themselves, not our utility model, what would their cost differential be, high level? And obviously, as everyone knows, like with our energy as a service model, with our utility model, there is no upfront cost. Obviously, we carry all of that. That's our value proposition. And we ensure that the cost of the renewable energy fee, the cost that we otherwise are going to charge to the building on a forward basis for the entire duration of the term is less than conventional heating and cooling. We all understand that very clearly. But let's say you don't want that option and you want to buy it. What kind of dollars are we talking about?
Yeah, so I mean, if we want to talk real dollars, absolutely. Anyone reach out as to any one of us, we'd be happy to talk in more detail. But to walk through the process, I mean, number one, you want to know and have a comfort level. Hey, geo is interesting. I want to get into it. How do I determine that's real? So to our earlier point, there's that feasibility study. We'll bring a rig on site and understand, how quickly can we get a hole in the ground, as well as do some engineering. That gets you to step one of, okay, this makes sense. Let's move forward. Now we got to design the system. You have some standard, soft costs of engineering, setup, project management. But the main bulk of the cost here is your drilling. So in order for us to not be on your critical path, we almost 99% of the time will drill before your buildings or your shovels in the ground. So we'll be first on, first off site. That's where the bulk of the money is spent. Afterwards, we're integrated in the process of, we got to tie things into the building afterwards, build a mechanic room and such. So there are some incremental costs thereafter. But that kind of takes you right to the end. And once you start operating, to our point, it is a much easier, you're buying simplicity. So it's an easier system. There's less money that goes into the operation. But with that is the care component of it. So it has, we have to take due care and make sure this asset, which should be a very good investment for you, is going to outlast the life of the building. So if you sort of think of it as, a curve of cost, a lot of the cost, if not call it 50 to 75% of all the cost of a system, are going to happen when you drill those boreholes. So that's really where the project is.
So it sounds to me like we're going to be basically you're going to double, maybe 2.5 times your cost of conventional upfront, but perhaps the ongoing operating cost is not as high, not super useful to developers of condominiums. It is what it is, I suppose. That's very interesting. That's ultimately why we have our utility model. With that, folks, we are at 11:30. We have gone officially, or 11:31. We've officially gone 31 minutes overtime. I really appreciate all of the questions. I appreciate the enthusiasm. We are going to be doing this more often. Our goal is to be doing these once a month. So please stay tuned for our next topic. It's going to be very relevant to all of the stakeholders that are currently on the line and to buildings as a whole. And I would like to thank, he's no longer here, but definitely thank you to Deloitte and thank you to Andrew for joining us. And of course, thank you to Matt and to Kyle. And thank you to you all. Have a wonderful day on behalf of Subterra Renewables. Goodbye.